If you're looking into buying life insurance, cash value life insurance specifically, you've probably come across the term called a MEC, or a Modified Endowment Contract. Whether you're looking to buy whole life insurance or index universal life insurance, this term called MEC gets thrown around all the time like you're supposed to understand what it means. Most of the time people don't even understand what it means, and they don't understand the negative ramifications. They don't understand where the positive elements of a MEC might be and how you could actually utilize MEC to your advantage. In this video, what I'm going to do is explain to you how MEC works, what MEC is, and how you can actually avoid it to take advantage of growth in the short term, or maybe if you're later in life, showing you why a MEC isn't necessarily so bad. So if you haven't already, make sure you're subscribing and hit the bell. That way you're notified every time I launch a new video, because I got videos like this coming out all the time. Let's go. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and we are going through modified endowment contracts today. And you know, this is just kind of one of those areas where I think a lot of people, agents specifically, need to really understand what a modified endowment contract is. They need to be able to explain it to their clients better. And if you're somebody who's looking to buy a cash value life insurance policy, it's important that you understand what the MEC rules are, what it even means, how the regulations were created, and that will empower you to be a more educated consumer. That way the odds, you make sure that your policy is designed in alignment with your values and beliefs and what your goals and objectives are. And if you don't understand what the MEC rules are, and you don't understand how to look for what the MEC calculations are, then you're probably, unless you have an educated agent, you're going to run into a situation where you probably don't have an optimally designed policy. So that said, let's just talk about this for a second. So basically, the MEC was created in 1988. Now, the Tax Reform Act of 1988 created something called TAMRA. And TAMRA basically was created because of the fact that people were putting so much money into cash value life insurance contracts that with the creation of 401ks in 1981, what happened, people were not contributing as much, and the government and the officials wanted more money to be going into qualified accounts. Remember, like, we look at qualified accounts now, like 401ks, IRAs, stuff of that nature, 457s, TSPs, 403bs. We look at those as just kind of the normal way of investing. But back then, they were all new accounts. And in 1988, the Tax Reform Act basically was created to, or the TAMRA in the Tax Reform Act was created to make it so people would stop putting as much cash value into whole life insurance contracts and universal life contracts at the time. Now, why would they do that? Well, what happened was, because of the fact that they were putting so much money, they wanted to redirect that money, and they wanted to take away the advantage of all the benefits that came along with a life insurance policy. Now, it's not like they got rid of them, but they basically restricted them. And I want to show you how this works and basically explain how this works. Now, when you get into a life insurance contract, you buy a death benefit, okay? So when you buy a death benefit for a life insurance contract, what happens is, let's say in this one you bought a $500,000 death benefit. Now, when you're buying a cash value life insurance policy, let's call it whole life insurance, the life insurance company is going to say you have a maximum amount of money that you're allowed to put into the contract, up to what's called the 7-pay test. So what the 7-pay test is regulators in the Tax Reform Act with TAMRA basically said the 7-pay test is the premium that would make it so whole life insurance was fully paid up. And you could not put more cash value into the policy than would make the policy fully paid up over that 7-year period. And that is the max they would allow you to put in and keep tax benefits, the tax-free nature, right, of everything. So what would happen is, if we look at this as the max right here, and you were funding it here, then you're good. If you were funding it here, right, and you were putting money above the threshold, above the MEC threshold, what would happen is, that's bad. You lose the tax-free benefits, and then it becomes taxed as ordinary income, right? But here's the deal. A lot of people don't understand this, that there's also a minimum that you can pay in a whole life insurance policy, for instance, right? That minimum would just be 100% base of the insurance to make it so it pays all the way to 121 years old. And so anything, this is when we talk about a properly designed contract, anything in this range between the max and the minimum is flexibility for you to be able to design the policy according to what your goals and objectives are. So when we look at this, it's really important to understand that. So let me be really clear. A MEC is when you exceed the 7-pay test. And it's important to understand that a MEC really is much more clean on a whole life insurance policy than it is with, like, say, an index universal life policy, because of the fact that index universal life policies can actually never be paid up. Index universal life policies have other premium tests to come up with their MEC limits, right? Because there's a thing called the guideline level premium test, cash value accumulation tests. You have to look at these things differently, but it's important to look on the illustrations to figure out how this all works. Now, the MEC test will be on there, but it's not as pertinent to IUL as it is to whole life, because of the fact that it doesn't really fall in line with the nature of what the MEC rules are, because you can never truly pay up an index universal life policy because of the fact that it's on a universal life chassis utilizing annual renewable term. And while sometimes on the illustrations you'll see a 0 in the premium department, that doesn't mean there's no cost for that premium. It just means it's called a vanishing premium, meaning you don't see it there. It's happening on the back end of everything. But one of the important things to understand when you exceed that MEC limit, for instance, and you breach, I'll say breach the threshold for the MEC limit, you lose the tax advantage nature of the cash value while you're alive. And while that may be the case, it's also important to understand that you never lose the tax advantage nature and the tax-free nature of the death benefit. So that is where sometimes the living benefits, well, I'll say this, sometimes it's advantageous to MEC the policy if you're later in life and if you say, hey, I'm doing this, and this is typically for wealthier people who are saying, I'm never going to touch this money. I want to leverage, say a percentage of my net worth because I want to pay, I want to, transition that to the next generation in the most tax advantaged way possible. I can MEC this, I can grow it, I can get good living benefits while I'm alive because the living benefits, because of the fact they're riders, they retain their tax-free nature, and then also the death benefit is going to be tax-free. What will happen, the downside is, if that person wanted to tap into the cash value while they're alive, then it's taxed as LIFO, or last in, first out, meaning any gains that you have on the policy are going to be taxed as earned income before you get down to your cost basis, or the amount of money that you've actually paid in premium. Once you get down below there, that won't be taxed. The other element of the tax advantages that you lose when you MEC the policy is that you actually, if you try to access the money before you're 59 and a half, you actually are susceptible to the 10% access penalty the same way you would be in a qualified account like a 401k or an IRA. The other element to this also that functions very similarly to a 401k and an IRA is the fact that this money is going to grow tax deferred, right? So it's going to grow. That's one good part about it, is it's going to grow tax deferred. You're not going to have to pay taxes on your MEC policy every single year. Now, as long as you fall underneath the MEC threshold and you follow the 7-pay test, and it's one of the things that I say all the time, is I show this all the time, and I think it's really important to see, is that if we look at this, as they say, all right, there's a maximum that we're allowed to pay and there's a minimum we can pay, and the 7-pay test is the MEC. So what we try to do is we try to fund it right up to this limit. Like if like hypothetically speaking, if they said that the max premium, that if the MEC premium would wind up being $10,000 per year equals a MEC, what we want to do is fund it at $9,999. That's what we want to do. And so what we do with this, that $9,999, we create our own MEC. We call it a maximum, max efficient contract. Because life insurance is a contract. It's contract law, right? When you sign on the dotted line, especially with a whole life policy, the life insurance company is contractually obligated to meet their responsibilities and their obligations to meeting you and meeting the obligations to you and making your policy whole. And that is with the death benefit and the cash value growth through the payment and participation of a dividend. That's how it works, right? So I think this is really important to understand that when we look at this, there are different ways to structure the policy. There's like literally an infinite amount of options that you have there. At the end of the day, when I look at it, when we keep the policy as a non-MEC, we basically have one of the most powerful and flexible assets in the world. It's going to give you bond-like returns, muni bond-like tax treatment, and money market-like liquidity. To me, that's super powerful. Now, if you are later in life, like I said, and you want to utilize some of your money for legacy and living benefits, and you don't plan on tapping into the money at all, you know it's there if you absolutely need it, but remember, it's going to function more like a qualified account, if you will. However, what's going to happen with that is that you are going to have the living benefits and the death benefit to your availability and to your benefit, right? So there is a leverageable component to that, and I can think of a lot of areas where that would work really well. Most people, however, are going to look to avoid MEC, and when you are looking to avoid MEC, just understand the reason that this all happened, think about it this way, the reason that the regulators created MEC in the first place is because people were jamming so much money into these policies because of the benefits of them. So now all they did was put a governor, they put a cap on how much you were allowed to put into the policies and retain the tax benefits. So for me, anything the government wants to restrict my ability to do, I'm going to do it right at the max capacity, right? Because there's a reason they're restricting it. And you know, the wealthiest people in the world, the most successful people in the world do this. Banks, corporations, they're the largest holders of whole life insurance in the world, and this is why. So hopefully you found value in this. If you have any questions, leave a comment in the comment section below. Happy to engage with every single one. I think this is one of the elements of these policies that people just need to understand, especially if you're a life insurance agent looking to help people. If you haven't already, subscribe, hit the bell, that way you're notified every time I launch a new video. Till next time, have a blessed, inspirational day. We'll see you soon.